Welcome to the course Introduction to Financial Accounting. This course is designed for the beginners and it is completely free to the public. So without further ado, let's get the ball rolling. There are 5 categories in accounting, which are assets, liabilities, stockholders' equity or shareholders' equity, revenue, and expenses. And we're going to discuss each of them in this lesson. Speaking of assets, you may think of your phones, computers, cars, chargers, or even your pencils. And yeah, they're all assets. However, someone may say that youth, handsomeness, honesty are also assets. Well, yeah, they're assets in a certain way, but unfortunately, in accounting, they are not considered assets. In accounting, assets are anything that is valuable and a business owns, which means the company can sell it to other companies. For example, you can definitely sell your phones or computers to other companies, but you cannot sell honesty to other companies. And that is the major difference, and I hope you understand it. In contrast to assets, liabilities are the debts a business owes, representing claims on its assets by outsiders. What do I mean by that? For example, if I owe you $10, the $10 bill will be a liability for me, but at the same time, it will be an asset for you. A company can have liabilities like loans, unpaid bills, account payables, mortgage, and so on. Let's compare the difference between stockholders' equity and owner's equity. Basically, the term owner's equity is used in smaller businesses, like sole proprietorships as well as partnerships. It represents the owner's share in the business. By contrast, stockholders' equity or shareholders' equity, and both of them can be used interchangeably, they are used in bigger businesses like corporations, and it represents the stockholders' share of company value. And here is the most fundamental, the most important equation in accounting, and accountants use it every single day in their work. And the equation is owner's equity equals assets minus liabilities. So always keep that in mind. It is super important. And basically, the equation shows how much value is left for the owners of the business if the company has sold all its assets and paid off all its debts. And I'm going to repeat the equation again and again in the future lessons. Revenue is the income of a business, and it can be classified as operating revenue and non-operating revenue. Operating revenue comes from the company's main business. The common examples are selling products and providing services. A non-operating revenue comes from side activities. For example, interest income as well as rental income. What's opposite to revenue? And the answer is expenses. Expenses are the cost a business has to pay in order to operate and earn revenue. Expense accounts differ from business to business, depending on individual company needs. And the following are some common expenses that many businesses have. For example, there's wages expense, rent expense, utility expense, supplies expense, etc. That is the end of the lesson, and I hope you enjoyed it, and I'll see you in the next episode.